Assalamualaikum warahmatullahi wabarakatuh. Uh, Good night. My name is Jilwanto Marzal, and I'm from Group 3. My group including Balqis Amalia Putri and Revina Maharani. So tonight we will present it about analyze company. So first we have the balance sheet for December 1, 2019. It have debit and credit. We have cashier, comparable, inventory, and etc. So the question is, first, journalize the December transaction and adjust entries. Assuming analyze use the proper inventory method. So let me move on to journal entries. So there is following transaction occur during December. So the December 3rd, purchase 4,000 units of inventory on account at the cost of 0.74 per unit. The journal is merchandise inventory, $0.74 multiplied by 4,000 units. It's equal to $2,960, and in credit is comparable $2,960 because we buy the inventory in account, so the credit will be comparable. So next, December 5, sold 4,400 units of inventory on account for $0.90 per unit. It sold 3,000 of the $0.60 units and 1,400 of the $0.74 per unit. So the journal will be accounts receivable in debit, $0.90 multiplied by 4,400 units. It equal $3,960, and in credit is sales because we sell it. So in credit $2,960 also. Next we journal the cost of goods sold. Cost of goods sold in debit $1,800. Merchandise inventory in credit $0.60 multiplied by 3,000 units. It $1,800. And the next one we will journal the $0.74 per unit. In debit is cost of goods sold $1,036,000, and in credit merchandise inventory $0.74 multiplied by 1,400 units. It will be $1,036,000. Next is transaction number 7. So granted the December 5 customer $180 credits for 200 units of inventory, return costing $120. This unit were returned to inventory. So in this case, the journal will be sales return and allowance in debit $180, account receivable because they return our sales, so our account will be less. So account receivable in credit $180, and then again we journal the cost of goods sold and inventory. So merchandise inventory in debit $120, and then cost of goods sold also $120. Okay, next transaction date of 17. Purchase 2,200 units of inventory for cash at $0.80 each. So in this case, we purchase the inventory in cash. So the journal will be Mercedes inventory in debit, $0.80 multiplied by 2,200 units. It equals to $1,760. And then in cash, we also cash in credit, we also write it $1,760. Next, on 2020 December, sold 2,100 units of inventory and account for 0.95 per unit. It sold 2,100 of the 0.74 units. So the journal will be conservable 0.95 multiplied by 2,100 units. It equals to $1,995. And in credit sales, $1,995. And then we journal the cost of goods sold in debit, $0.74 multiplied by 2,900. So it will be $1,554. And then in credit, which is inventory, $1,554. Okay, we move on to adjustment. In adjustment, they say accrue salaries payable $400. So the journal will be salaries expense of white bags and salaries expense in debit $400, and then salaries payable in credit $400 because we already write it but we don't pay it. So it will be salaries payable in credit, not cash. Okay, move on to the second one. They said depreciation $200 per month. So in this month we have $200 depreciation. So the account will be depreciation equipment expense in debit $200, and then accumulation depreciation equipment in credit $200. In the version we have like fee mark. That means we are deposit on a Conti or ledger. So let's move on to the Conti. Okay, as you can see here, we have the Conti. Okay. We have cashier, the amount of final cash we have in 31 December 2019. And then we have accounts receivable, inventory, equipment, and etc. So this amount of cash, accounts receivable, inventory, and etc. will be posted on trial balance after adjustment. Okay, so trial balance after adjustment will be presented by Balqis. Balqis, time is yours.
The next topic will be explained by me, which is about the trial balance after adjustment for the analyst company for the month ended on December 31st, 2017. In the account name, we have cash in debit about $3,040, account receivable $9,675, inventory $2,250, equipment $21,000, accumulated depreciation equipment $1,700, account payable $5,960, owner's capital $27,000, cost of goods sold $4,270, sales revenue $5,955, sales return and allowance $180, salaries expense $400, salaries payable $400, and last one is accumulated depreciation expense about $100. And we sum up all the debit and credit, so it will be balanced about $41,015. And after that, we move on to the financial statement. The first one is analyst company income statement for the month ended on December 31st, 2017. The particulars are, the first one is the sales revenue. The amount is about $5,955, and we have sales return and allowances about $180, and cost of goods sold $4,270. So the sales revenue will be minus with the sales return and allowances and the cost of goods sold. The result will be gross profit. It's $1,505. And after that, we move on to the operating expenses. We have two operating expenses. First one is salaries expense about $400, and the accumulated depreciation expense $200. We add up those both of those operating expenses, and the total operating expense is $600. And after that, the gross profit $1,505 will be minus with the total operating expense $600. And it will be the net income about $905. And after that, we have analyst company owner's equity statement for the month ended on December 31st, 2017. The particulars, the first one is owner's equity. December 31st, 2017, the amount is $27,000. We added with the net income, the previous net income, about $905. It will be owner's capital for December 31st, 2017, $27,905. The next one for financial statement, we have classified balance sheet for analyst company for the month ended on December 31st. The particulars, first one, assets. We have cash, about $3,040. Account receivable, $9,675. And we also have equipment, about $21,000. And it will be less, it will be minus with the accumulated depreciation for equipment. It's $1,700. And it will be $9,300. And we also have inventory for assets. It's about $2,250. We add up all of the assets, and the total assets will be $34,265. And the next one is for liabilities and equity. The liabilities, we have two. It's account payable. It's $5,960, and salaries payable $400. We add up those two, will be total liabilities $6,360. We have equity for the owner's equity, which we get it from the owner's equity statement for December 31st, 2017. The total for equities is $27,905. The total for liabilities and equities will be $34,265, and it's also balanced with the total assets. So the result for classified balance sheet, it's $34,265. That's all from me.
Okay, thank you, Balqis. Next. The next one will be presented by Revina. Okay, Revina, time is yours.
Okay, thank you, Jill. Before first in, first out is assumes that the oldest product in a company's inventory have been sold first and goes by this production cost of goods available for sale. That one December beginning inventory 3,000 units. Before is assumes that the oldest product in a company's inventory have been sold first and goes by this production cost of goods available for sale. That one December beginning inventory 3,000 units, 0.60 per unit. The total cost is $1,800. 3 December purchase 4,000 units, 0.74 per unit. The total cost is $2,960. 7 December purchase 2,200. The cost is 0.80 per unit. The total is 1,760. So the total goods available for sale 9,200, and the total cost is 6,520. The goods sold is that one this December 5 sells for 4,400, and December 7 return sales, so minus 200. December 22 sales 2,100, so the total of goods sold is 6,300. Ending inventory for ending inventory, we use the final inventory of goods first for sale minus goods. For ending inventory, we cost of goods available for sale minus goods sold. The total is 2,900 units. So for the ending inventory, we use the final inventory of goods for of sales. After using inventory on the 1 and 3 December, there are 7 units remaining on the 3 December is 700 units. Multiply 0.74. The total cost is 580. In December 22, 2,200 units. Multiply 0.80. The total cost is 1,760. So the total ending inventory is $2,278. So cost of goods sold is the total goods available for sale minus ending inventory. We get 4,242. In LIFO, method assumes that the most recent product in a company's inventory have been sold first and use those costs instead. Cost of goods available for sale, same in FIFO. So between FIFO and LIFO is ending inventory. In ending inventory in LIFO, 2,900 units. Ending inventory in LIFO, we use final product. So ending inventory is 2,900 units. Multiply 0.60. The total cost is $1,740, and in 1 December, uh, 2,200 units. Multiply 0.80. So the total is I'm sorry. This is typo. So the total cost is 2,900 units multiply 0.60. So the total cost is 1,740. Cost of goods sold is cost of goods available for sale minus ending inventory. So the total of cost of goods sold is 4,780.
That's it, Revina? Revina, is that it?
Yeah, that's it.
Okay, thank you. So that is our presentation about analysis company. We ended with Assalamualaikum warahmatullahi wabarakatuh.